Okay, testing. All right, I think we're good. Okay, so I'm going to go back to doing just weekly recordings and posting them up instead of doing the live broadcast because I'm not getting any viewers. If you want to find out the history, you can go back to the live sessions that are on the channel. So this week, not too many changes on the front end. I've been doing a lot of bug hunting. So the Charles Schwab data feed, the live data feed, has been giving me issues. It's been, during the day it's constantly falling behind, and that I can't fix. But now we've started getting some intermittent times where it just stops sending. It's not. I'm not getting the connection drop because I detect that, but it just stops sending data. I'm going to have to dig in further into that. I've done some workarounds, and I found that my Sunday session didn't come back up on time because I started everything up like 30 minutes before the market opened, and things failed. And so we've been, it happens when you introduce features, things break, and so now we're going back and trying to fix existing features that were not broken before adding a bunch of stuff. So I thought this week we'd start working on some things. I'm still in data collection mode for doing the analysis, for setting up some of these trades, and I've also come in and started I added a dashboard for tracking an options portfolio. So it's called like a Theta portfolio where you do nothing but options in that account, and you just manage by selling options to collect Theta, and it gives you a nice consistent profit. Well, the past month, we've had I guess the market's paused, but it's been a lot of rotation. But when things rotate in the market, it means items that were up go down, and then other underlyings that were down go up. And some of the items that I was in have gone down, and they've challenged their positions. I think most of them have gone in the money now. But we're also running into earnings, and so I'm pretty sure we're still in the kind of that Goldilocks period for the market. It won't be until a couple of months later that we may start seeing some serious downturns, because right now it's the summertime. Summertime trading's light, and way things feel. I've mentioned to some people that this kind of feels like 2007, that summer before everything went, and we're getting that feeling again. Because we have the AI bubble. Everybody knows it's a bubble, but when's it going to pop? And nobody knows when it's going to pop. And this earnings quarter is really highlighting some of the stuff. It's like things are still being spent, and as long as things are being spent, then things are going to keep going the way they are. But people are now starting to question the spend, and I think Google this week announced that they've gone into negative cash flow. And what's made this bubble different from any other bubble in the market in the past is that a lot of things, the real estate bubble was, banks were just pumping out all this debt. They weren't even checking what they were underwriting, and then it was just a churn. And whoever got caught with it at the end was going to be the loser, and then the whole market crashed with that, because once it stopped turning, then everything started falling. And before that, the dot-com, most of those businesses were cash negative to begin with, and the money went into them anyway. This one's been different because it's been cash flow financed. Maybe it's allowed it to go bigger, and now that we started going to negative cash flow, that means now they are actually having to borrow to do the investments. And so that's something a little bit different. It still gives it legs. The dot-com went for several years of running negative cash flow. It's just that this one's a whole lot bigger, because dot-com taught us one thing, is that it's a winner-take-all market. And AI is looking like it's a winner-take-all. There will be only one, like in Highlander. So that being said, some of the positions I'm in have gone has started to be challenged, and we'll just kind of go through and look. So this is the dashboard I've built. So this is something that you really can't get on your broker, and it's nice to have something to look at to know what's going on. And if I look here, if I look at my initial capital that I had to outlay for the option positions, it was 7,000, and now it's requiring 13. We've nearly doubled because everything's gone in the money. So you went from a 20% requirement to a 40% requirement. It was higher last week, and what I was waiting on, because I said, we're running at 75, 80%, and what I was waiting on was for earnings to come in on a couple of the underlyings. It was EQT, it's a natural gas play. It's almost a pure natural gas play. What EQT does is that they drill natural gas fields, they have pipelines for natural gas, and then the big thing is that they do LNG. So they take the natural gas, turn it into liquid form, and ship it out overseas or to whoever needs liquefied natural gas. So they're they're not totally integrated, but they have a lot of verticals in the natural gas space that kind of helps offset some of the cost of running it. And so the LNG part is what we're interested in, because with the Gulf issues going on and oil starting to be more of a commodity that's going to be more rare, because you have 20% of the oil comes out of the Persian Gulf, and if that totally shuts off, then everything's going to be in a world of hurt, and you're going to need alternative energy solutions to keep going. And the biggest alternative energy solution that the U.S. has is natural gas. There's so much natural gas in the ground that we could go from an oil-based to an electric-based using natural gas, but it'll take years. It'll be a shock. And EQT is one of those companies, since it's a pure play for natural gas, not exposed to oil and all that. It's something that I feel is something that I could keep a regime going on options that I could constantly roll. And it's only the past few months it's kind of fallen. That's why we got a challenge position that the puts went into the money, but you're still able to get decent premium, and you just roll out and collect credits. And I've crept up on the credits that we've collected. Let's see if we have the positions here. So EQT, I've got a total net cash flow of $700, and what I was waiting for was the earnings to come in this week for EQT. EQT earnings were better than expected, and so the price jumped up like $3 or $4 on the stock price. And that was what I was waiting for before I could actually go in and start managing the position more aggressively. And so now that the news is out, even if there's some drift, I can be more aggressive on, instead of just having the puts and rolling the puts, I can now sell calls. Because EQT is not going to move around a lot, because it's a kind of a nuts and bolts kind of company. It's just that with natural gas being an energy play, there's an elevated risk on energy, or implied volatility is a little bit higher in the energy sector overall, and that's what we're trying to do. We're trying to gain a little bit more edge on the energy play, but not be totally exposed to the roller coaster ride of what oil will give you. So let's navigate over to the positions summary. Okay, so for EQT, this is kind of the summary of the position. The current reserve is 4,000, and I'm at 700. And so if I want to kind of lock in a 10% gain as we manage this position, I can lose a couple of bucks out of this position to roll the puts down to get them closer into the money to where they can collect a bigger credit, and then we just use that to finance more. We're going to start selling calls and taking those calls, taking the credit received from those calls, and start rolling down positions to get them closer to being in the money. And then once we get there, then we can stabilize and then continue selling puts and maybe calls at this point to get the maximum out of this position. I just wanted to start off with puts, and then we got challenged, and then it's like I can't sell calls because we're running into earnings. So we can go, let's look at campaign detail and open positions, EQT. So these are the transactions that we've done recently. And this week after earnings, I did sell a couple of calls and collected $60. So we're going to start rolling down. So I should be able to roll at least the 55 put. We'll start with the lower one. We'll roll that down to 54 and collect some additional credit, or we'll spend. It'll be less than $1 for the roll. So once this gets close to, I think we're 21 days. When it gets down to 21 days, I'll roll it out for 2 weeks and roll it down $1, and then we'll collect. And in the meantime, we're going to continue to roll. We're going to sell calls, and as the calls expire, then we'll continue to sell calls. I'm just selling them out basically a week or two in advance to where you can get a higher turnover rate. And so I sold 2 calls at 30 cents a piece last week, or earlier this week. Let's see. Okay, the other position I have is Intel, and we're going to go ahead and roll these in. So I've imported these off of the brokerage account. And so what I did is right before earnings yesterday, I decided I'd roll Intel out a week just to collect a little bit of credit from the higher implied volatility before earnings. And I thought maybe we could get back out because I'm at 107, and after earnings last night were announced, it jumped up to around this area. I think it got up as high as 110, and then came down to about 107 and said, okay, they'll put us right at the money, and we can continue to sell. And at that close to being at the money, then I could roll it down $1 just to gain a little ground. But then the earnings call happened after, the market was shut down. And apparently people weren't quite as impressed with the earnings call. And so this morning when the market opened up, it was down at like 102, 103. And it continued to fall today. So in one of my retirement accounts, I'd gone ahead and sold a call out for at $100 because I got taken into stock at 97, and so I sold a call at $100. I gained at least $300 off of that, and $6 for the call that I sold, and it's now out of the money. So it's like it was a good $600 to make real quick. So we will, as my application grows, I'll be incorporating in my retirement accounts, and we'll cover those too because I run them all as a Theta style. And this is how I'll go through and start managing things, is by using this application that we've built. Okay, so we're going to import it. So I think this is 731 to 87. This was the one that had the 731 expiry. So we will go and add this to the existing position. Okay, so we'll go to the position summary. I think I may have to refresh here. Let's see. Okay, so these have not. This is where I've got to work on. I'm going to find. Let's see. Do I have? Okay, here's the net cash flow. Okay, so I'm trying to see. I need to have the latest. And so this is something I need to add for what we need to add to this. Okay, so on this I need to have the last option, the open option expiration date, just to where I can keep track of it at a summary level. Okay, so from these I can see we're running at, do I have, how many? I'm having to check things. Okay, let's go back to, okay, so I've got pricing off on the option. So it should be about $4,500 that's required. And so for a 10% return, I need about $400 or $500. Because at this point, I'm not worried about getting to break even. Because even though it's in the money, it's close enough in the money that I can still lock in a positive return. It's just that the days of being in the trade is going to go on longer than what I'd like, because I'd like to get these 5% returns every week, but now it's going to be a month that we've been going on to this, and so that reduces your overall portfolio return because you're slowing down how fast you're turning over your capital. So now the capital's kind of turning over, but now I'm using the theta that we're collecting and turning it into just rolling down the position to where we can get into a better position as the price has been going against us. So we started off at 110 and we're down to 105 on this. So we will start rolling this down more. Let's see, we've collected $600. I think that's our. So as I roll down, this will start going down. So I can easily roll this down $1 and still be above my 10%. And that's kind of the goal right now, is to get out with a 10% gain. If it continues to fall, then we'll get more aggressive and take this to getting out at break even. And so all of these cash flows will start coming out. Right now we're at a positive. Okay, yeah, so some of the things I'll be adding is to getting a live update on this. It's just that since we were dealing with data feed issues, I have not been able to apply any changes to pulling in live actual updates. And so I still just have the initial capital and some of the current capital reserve on it. Okay, so we'll just go back to the dashboard. So this is just year to date where we are with transactions, since I haven't closed any of these out, and right now they're all running positive if everything goes back in our direction. HIMS, let's take a look at HIMS. So HIMS today, I've been rolling this call for a few weeks because HIMS had a run up in price, but since it's so volatile, on the price that I've felt okay just rolling it out in time. So I think we have this now. It's sitting. Yeah, so I got taken into ownership back in October last year, pretty quick. But we've been rolling and rolling, and so I think I was assigned at 52, and my break even is now at 41. And the stock is trading at just under 30. It was around 35 earlier this week, but it's continued to fall as the market has fallen because it is a high beta stock, so when the market falls, it falls faster. And if we look at the details on this one, okay, so if I look at HIMS, my effective cost basis is 41. So if we look at HIMS, I've been rolling this 30 call. It started off at 29. I rolled it up to 30. And we've been rolling this 30 call for about a month and collecting. So I'm collecting over $1 whenever I do these rolls. So that's good. And now that's come down, the stock has fallen below 30. I'm going to let this kind of roll off. I've got basically 3 weeks, and we'll make a decision at that time if I roll it or roll it up and out to keep collecting, or do I let it come down and let it. Either way, I'm just pulling out the theta that's been there. And we've run $10 off of this position. That's why I only have a 1 lot on this. I wasn't very overexposed with this, and that's kind of one of the reasons why I've kept it going, because it's small and it generates enough theta that I could recover the position while we continue to go. So it's occupying capital, but it's not negative capital, because I've taken almost a 30% return on a cash flow basis. Now, from a cost basis, I'm underwater. Another $10, so it's another $1,000 I'm underwater. But we can continue to eat away at it, because it does, since it's a high enough implied volatility, that we can continue to collect it, and I'm covered. So I'm selling calls, and if it runs ahead on me like it did the past month, you can still collect a decent amount of theta as you continue to go. So yeah, so this happens eventually as you do stock. Once the market kind of slows down or pulls back, the first thing you do is that you run into being challenged, and if you're aggressive, you could blow your account. But if you manage it wisely, then even with this expansion, you can still manage it. It's only if we have a full meltdown that you'll run into issues, and I'm not expecting a meltdown, at least for the next couple of months. But as I said, July has been picking up to a point where it's feeling very 2007-ish, or not even the dot-com. The dot-com, it just kind of softened, and it just continued softening, and then the IPO stopped, and then you went into a recession. But it has a hint of like 2007, and that's what's got me worried. And you just keep playing until the music stops. But right now it's time to roll things back. So I'm going to start getting aggressive on getting things down into a more manageable position, to where we can get down under that 40%. Because at 40%, if everything goes into the money, you're still under the 100% threshold, and so you're fine. You're not paying margin interest on anything. Okay, so what I'm looking at next, as I work on these the bugs that I have existing, we're going to start adding up the risk model that I've always wanted to have, that was a little hard to implement on a spreadsheet basis and keep track of everything. But with this application, I can start putting into a model to where you can actually do your risk assessment on the option to see if you really want to. I've got to see if I can pull in that, if I make this trade, what my expected capital requirements are going to be. Because if you look at like SpaceX and you try to sell an option on SpaceX, the brokerages, most of them are require that you put up 100% cash on a Reg T account. So if you have a Reg T account and want to do SpaceX options, you've got to put up 100% cash. Well, if I'm putting up 100% cash, my expected return is 5 times lower than what I'd expect to pay at a 20% return. That's where the risk model comes into play, that you can start looking at things and say, well, they're charging me 100%. Am I getting paid? Because at the end of the day, the reason why you're selling Theta is that you want to get paid. And you want to get paid at a decent rate of return. And after you modify it for risk, are you getting the risk adjusted modified return that you're expecting to get? So we'll be building a tool that will pull in the SPY. And so if I'm looking at 20 delta or 30 delta for an option, then I will pull in the SPY equivalent for that time, and you can do a comparison. So SPY will give you your return on capital of what you expect at a market rate of return off the option, and then look at your capital return you're expecting to get off of this option that you're looking at. And so that's one thing. And then you'll have to do some self-risk assessment on the item, because I can pull stuff like beta and adjust it for beta for risk management and stuff. And then we can take implied volatility versus the market implied volatility, because we have VIX, that's basically the market, and then I start looking at the IV of the individual and compare it. So are you getting paid? And if you're not getting paid, then you stay away from it, because you're taking on risk and not getting paid for that risk that you're taking on. And that's what you'll see, that some of the more popular underlyings, since there's so much demand for it, that the risk premium falls on it, and you're not getting paid for the risk that you're taking on. And that's why if you look at Wall Street bets and whatever they're into, those are things you stay away from, because there's so much interest in the stock and so much demand for it, that the first thing that gets cut out of that demand price for an option is the risk. And so that risk, you are assuming more risk than what you're getting paid for by getting into that underlying. And that's part of the thing. So that's why we'll be building a potential trade dashboard, to where you can look at the SPY option for deltas for that same time period at the underlying that you're looking at, and start working out what your return on capital will be with that option. So that's some of the future stuff that we'll be working on going forward. And I'll give weekly updates on how I'm managing these positions. Right now it's just EQT, HIMS, and Intel, and that's all this portfolio can handle, because as you saw on the dashboard, I'm not double, but I am way over target. So we've got, I'm using $6,000 more than what I should be using at this point, and all of it is because Intel's gone in the money and EQT has gone in the money. If we can manage those positions down closer to at the money or in the money, the requirements will fall on this. And so as the requirements fall, then my usage will fall here, and they'll get us back. I'm running aggressive. If you're not used to running a Theta portfolio, it's better to be at 25 to 30%. And at 25 to 30%, you could go into being assigned every single position and still not have to pay any margin, because you'll just end up using up all your cash at that point, paying for all the stocks. But that's one of the reasons why you hold it at 30%. Here at 40%, I will run out of cash, and so then you'd have to borrow. This is the scenario that I get assigned on everything. The odds of that are not great as long as you keep your expirations out 21 days. That's kind of why with these earnings, I went ahead and rolled out. It was also because it was getting too expensive to roll before the earnings, and so I wanted to buy time in case things moved against me more. I wasn't expecting it to move against me more. I was expecting maybe things to stay same or get better, and like EQT, it did get definitely better, because now it's only like $1 away. on the price versus what the option price is on that put. So that requirement is I get it into the money, it's going to start dropping. That's why we be aggressive. So when I start looking at things, I made EQT's already merged into a single, because when I was building this, I just went ahead instead of managing separately, just rolled them in all into one. But that's why you're aggressive with rolling down one contract at a time, so that you can get that contract quicker out of the money, and then you can take that higher theta that you're getting paid and turn around and apply it to the rest of the options that are sitting out there. And you'll see that it just accelerates as you start rolling these things down, all things being constant. So that's where we are, and I look forward to next week giving an update, and hopefully I have more features to show. Right now, I didn't make any major changes. This is the dashboard. It's similar to last week. I think the only thing I've done is I added this late last week, and it was just working for the first time. And as I use it daily, I'm going to uncover bugs, and we'll fix those bugs and keep going. And that's where we are.